welcome to yet another issue of the Grey Market Talk between Thorsten Wegener, a former, now retired market maker, and junior bond god. I say junior because the real bond god's coming in later. Junior bond god, Nic Themistocles. And today, obviously, the topic is bond markets. A lot of stuff happened last week. I came across a very interesting interview, and Nic and I are going to discuss. Hello, Nic. Good to see you.
Good to see you.
Are you ready for giving your expertise opinion on what the senior bond god, Jeffrey Gundlach, had to say about the markets?
I bow to his excellence.
Brilliant. No, backstory is actually Jeffrey Gundlach. He was always somebody for me you listened to, but I was never, Jeffrey Gundlach. Fine. And then I was teaching at the time already. It was 2018, 2019, around this time of the year. And you were taking my class at the time. And Jeffrey Gundlach came out and said, listen, I know something is going to happen on the long end of the yield curve, but I don't have a clue whether it goes up or it goes down. However, what I see in the market, and that's where, as an options trader, I came in, he said, volatility is at an all-time low, especially in the TLT. And he actually used the TLT as an instrument to trade. And he said, I built up a straddle at the level we are at the moment, because the one thing I'm sure is we're not staying at this level. So the market will either go up or go down. Yes, that will cost me money. However, if I buy a straddle now and volatility just normalizes and the market stays for whatever reason where it is, I'll already make 40 to 50% for the time horizon I'll make. If the market moves in one or the other direction, even better for me. I start getting into the money further. And I explained that to my guys. The logic behind the option volatility we had there, did our analysis, and we all jumped on this trade and made tons of money out of it. So from that day on, every time I see him on TV or on YouTube, sharing his opinion publicly, I think that's where I have to listen to. And at the end of our conversation, I also have a little trade idea at the back. And just to say it here again, nothing we do is investment advice. It's just fun and analyzing stuff, but don't do what we tell you to do. It's not a recommendation. Have I done that correctly, Nic?
I think so. I'm not a lawyer, but it sounds pretty good to me.
Lovely. So let's fire up my presentation. I should have actually done that beforehand. Let's see, always the old share problem. How many times can you look for a button, use it, and not find it? I just don't get it. So
next time.
You see the gray mark?
I see it. I see it. You did the right thing.
So obviously, I'm not wearing a wig today. We can go a little bit more into the serious talk again and not talk about the horrible things we expected to happen, but I have a couple of words to say about that later as well. Absurdity of the week. I don't want to have full thoughts from abroad. It's just the topic about Mr. Gundlach and his slides, which are available on the internet. And by the way, I will post the link in the description as well, so you can see the full-length interview he gave. Well worth watching. And we start with the absurdity of the week from my tiny segment, Thoughts from Abroad. And I've called it, can I have some more porridge, please, sir? Because I read this news this week and I couldn't believe it. The Ministry of Defense decided that our soldiers, which are not very well equipped, well, they have pregnancy uniforms now, I guess, after we've restructured our army. And our Fuchs Spürpanzer, which is an infantry vehicle, has now doors which fit female pregnant soldiers. So we spend a lot of money on that because that's what we want to do. In a hot war zone, bring our pregnant women in, that they can get into the tanks. Anyway, now the ministry has decided that beef is very, very expensive and we can't give them proper hamburgers anymore because they are beef-based. So they've taken a couple of the products our brave soldiers were used to be fed in the field of the menu. And sorry, if I've ever seen a country in decline, Germany is the gift that gives on giving. Anyway, that's my absurdity of the week, and let's move on to the good stuff. So, bond god, Jeffrey Gundlach, double line capital management, one of the most consistent bond managers for the last, Nic, 30, 40 years out there in the market. Barely makes mistakes. If he makes mistakes, he manages to lose far less than everybody else. and is one of the guys you should listen to when he has an opinion about bonds. And I heard him once in an interview, and he said, you know what people forget? 60% of the time I'm right, and 40% I'm wrong. Yeah, even. That is a good ratio. He said, I was always lucky in my life that I'm not the 40% wrong at one time stretch at a time. There are intervals where I get it right and where I get it wrong. And well, he's a fantastic guy. Still lives in California. Let's start with this, because the whole idea in his presentation was, how are we actually making our assumptions? Everything we've learned over the last 30 years, pretty much since I started working, interest rates went from top left to bottom right, and inflation was falling and falling and falling and falling. And I remember as a young man on the trading desk, we had the desk analysts coming around, or the research guys, and there was a very clever guy, I think he has his own wealth management company, Dr. Vermouth is his name. Have you heard of him, Nic?
No, I haven't.
He was our analyst at the time, and he said inflation will not be a topic for decades to come. And everybody was like, how do you mean that? And I said, have you considered, you all have a computer now at home. The first IBM computers I had, they cost a bloody fortune in those days. They become better and better and better. And even if prices wouldn't go down, you get so much more quality in all these things we use in our life. It's unbelievable. Nobody has that on the radar. And that stuck with me. And his forecast was absolutely right. Coming back to Gundlach, what Gundlach said is, so if all our assumptions are based on correlations we have seen for the last 30 years, a secular downtrend in bond rates, and a secular downtrend in inflation coming with that. What's the situation now if something has fundamentally changed, if this doesn't hold anymore? Nic, we already discussed the classic 60-40 portfolio, which fit perfectly in that period. It's toast, isn't it?
Yeah, I think you have to, and for a while now, have to rethink how you structure portfolios. And you know, the classic role that the bond portfolio had, or the bond element in this sort of overall portfolio, it's kind of gone, because they are instruments are now sort of more positively correlated. And when you see that, what you have to do is to start putting in things which are acting in different ways. And that's why you know, smart money is looking at alternative strategies, whether it's macro, whether it's long short, or whatever that might be, because you have to get some negative correlation in that portfolio. Otherwise, you just have risk everywhere. Yeah, all going the same way. You make money on everything, you lose money on everything, and that's not very clever. And then you just add volatility. So the way to do that, introduce alternative strategies, and you know, the growth of the alternatives market is the place to be if you're an asset manager already for a while.
Yeah, well, you've talked about that since we pretty much started doing the gray market talk. Yeah? We're half a year in now, and I think it will crystallize later in that presentation. We actually start now, the narrative develops in the mainstream media as well, and it starts beating people around the faces where this is coming from. You mentioned it, the sovereign debt crisis, and this is such now becoming a topic that it is being discussed on the street. And when stuff gets discussed on the street, new trends develop, and people start thinking about it. Because we also had that, we're a little bit older, and we see this secular downtrend here. Even I, who has worked quite a while now in that industry, haven't seen an interest rate environment which could completely change. Yeah? So where's the institutional memory in this whole thing, how to handle markets like that? I think that's very, very interesting. And obviously it's really a fantastic show in Gundlach's speech he had there. He said, if you look at the olden days, you can't see my mouse in this projection, can't you?
Yeah, I can see it. Yeah. Huh? You have to move it around a bit. But
right at the beginning, in the olden days, he said interest rates, or central banks, were still managing, well, their own portfolio. They looked at their own currencies and at their own employment rates and at their own economies and made diverging decisions. If you look at the right end of the screen, we actually can already talk about a world central bank. Who's the leader of this world central bank? Is it the Fed still?
Yeah, absolutely. And sorry to say this, and this is probably nothing to do with what Gundlach was saying, but if you listen to the Bank of England, the ECB, and the Fed, you only need to listen to the Fed, because Lagarde and BOV just copy exactly what the Fed say. And it's absolutely embarrassing. And it doesn't go any way towards giving confidence to people that these great central banks are controlling things. In fact, it gives you the opposite view. So they are all following the same line. And remember, they all made the same mistake at the same time, except a few central banks that didn't go down the route of working in concert with their government to throw money at people, helicopter money.
So at one point in the future, they will all decide at the same time to go bankrupt, that you can't flee anymore, right?
Well, that's another question. Yeah, how do they all get themselves out of this mess?
Well, if they all suck, yeah, where are you going to put your money? If all at the same time, which is most likely what's going to happen. Just look at this chart, yeah. If really something starts burning down, you don't want to be the lone guy with a candle in the hand. You share it out to all of them, and then we will get our central bank controlled digital currency. Nic?
I'm less a fan of central banks actually having this digital currency, because it hands over too much control from government to central bankers.
Yeah, well, I'm not a fan of it, because what will happen then? We will see banks in crisis, and that's how they slip it in. They'll say, "Oh yeah, you've lost your life savings." Yeah, they'll start with the people on the street. Somebody worked their whole life. They have a nest egg of, let's say, 100,000 euros lying there, and then they'll say, "Yeah, you have lost it with the collapse of Deutsche Bank, but we give it back to you. But we give it back to you in central bank euros, which we control. If you sign up to that, then you can only spend our currency." And then you have it. Everybody will jump on that, and they have exactly what they wanted: complete control over the money flow.
Yeah, I mean, the government won't give the control to the central banks for that reason. But
they will run the central banks then, right? In England,
yeah, exactly right. So effectively, the moment you see a digital currency, then you know that there isn't an independent central bank.
Yeah,
it's fairly clear.
So obviously here, an aggressive hike cycle in context, I think that's what I always tend to forget. The fastness, the speed happened this time, yeah, is changing a lot of things you learned in business school or behind the screens when you were trading and were a young man. This is unprecedented. This is actually a sign of madness, almost, what we can see here, Nic. And it only had to happen because they were asleep at the steering wheel when inflation was creeping up like crazy. Well, because while they were printing money and didn't see it coming.
Yes, absolutely. They didn't understand. Well, okay, they didn't understand money supply. That's not really fair. They understand money supply, but they increased the money supply in the States was growing like 5 to 6% per annum. And if you have an economy where your sort of GDP expectations 2%, inflation at 2%, so that's 4%. So you need money supply at around roughly 4%, plus people save. So you add a little bit here and there, you end up with a number of 5 to 6% growing your money supply. Okay. And at the time of COVID, which was when the Fed stopped being independent and actually worked together with the government, they expanded the money supply something upwards of 30%. So the steepness of this interest rate rise is matched only by the steepness, if you like, of the growth of money supply, which created this inflation in the first place. And once the money is in the system, you can't get it out, right? So the only way to get it out is to grow or let prices go higher. And that's why 6 months ago I said, in my view, if they did nothing with interest rates, inflation would fall, because growth will gradually eat up all of this money that's been pumped into the system. You just have to be patient. Okay, they have jacked up the rates because they realized they made a cock up. And yeah, I mean, as I say, they raised the supply of money fast. They raised the interest rate very fast, the consequences of which they have not been able to fully understand, because you can imagine if you're a central banker and you've been turning up that dial and, you don't hear anything blowing up. So you turn it up even more, and you go right to the limit. You say 5.25%, and maybe we're going to do another one by the end of the year. And then what happens is you get a GDP print of 8.4% in the last quarter. And then you say, well, hang on a minute. Is this the right tool? Do I know what I'm doing? You know, you really have to ask yourself genuinely, do they understand how their own economy works? And I'd say, you know, I'm in doubt about that. And the problem is, the problems will be coming if rates stay where they are, if yields stay where they are, because as you pointed out in a few of your slides over the months, over the last few months, is that there's going to be a lot of refinancing from corporates, from individuals, from small companies over the next few years. They all locked up. So this year was probably not the issue. The problem comes next year, the year after, and the year after that. And of course, the biggest problem is for the government, because they've got the bill, they've got the interest rate bill already today.
Well, let me defend them a little bit, because we have seen after the virus hit, you had to shut down the economy, you had to put people away, and you had to increase the money supply hugely, because now I remember this country, Sweden, they didn't do all of that, and they're all dead now. There are no Swedes anymore.
Obviously, you're defending.
It's a wasteland.
Yes, indeed. So, and even, I mean, I have to say that as well. Boris Johnson said yesterday, I think, when he was being interviewed in the Commons, that you know, the lockdown probably did more harm than good on reflection. That's. We'll leave it at that. We'll go back to Jeffrey.
You know, when I think a middle talented trader like myself, and so pretty much every Joe Block on the street saw it, why do our enlightened leaders always do the wrong thing? Anyway, yeah, let's go back to Jeffrey, and the whole starting point, or the whole red line through the conversation, or the presentation he gave, was actually the interest burden. Yeah, and we spoke about that for weeks and weeks now. What is going to happen? And this chart is actually, it shows the blue line is the Defense Department's annual outlays in the United States, and the 12-month sum of federal government interest expenses is the brownish line we see here on the screen. That doesn't look good, right? That looks like somebody, a country is strangling itself as long as it wants to stick to the rules it implemented themselves, actually pay back your debt, and have to raise new interest. That will leave no money for the people anymore. And I have supercore inflation. Yeah, let's add that on as well, because I laughed my head off. Jeffrey gave the presentation and said, this is the blue line. The supercore inflation is what Mr. Powell thinks he has to have an eye on. So supercore inflation is the inflation without food, energy, and shelter. And he closed his line with, so what does it actually represent? Prices for pencils? So what are you going to do with it? Is that even if that would be the measure you should have a look out for, well, it goes pretty much stable sideways. It's not as if it's coming down fast, and the Fed has now liberty to make decisions. In that context, actually, the bits of Powell I listened to was actually also quite interesting. You remember when he said, we're not thinking about raising interest rates not that long ago?
Yeah, that was I think a year before they raised rates at the fastest level ever.
Yep. And now he said they're not even thinking about lowering interest rates. So I thought, oh, very interesting.
So we know what they're going to do. Okay. So exactly what they're going to do.
What they have to do. Yeah. They don't think about it, like they didn't think about it to increase interest rates when they should have done it. And then we're too late to the party. And now I think it's again the same dying down. No, we're not even thinking about lowering interest rates. Yeah, mate. If the recession hits and it becomes a depression, you will do that. And you will not go down 25 basis points a piece. You will go 50, 100 basis points, and fast. The same way we went up, my prediction, we will go down.
Yeah, I mean, I think that's absolutely right.
Then we have another slide. We spoke about that last week already. Small business average interest paid on short-term loans. Interesting is here, if you go into 2020, we have about 5%. Yeah? At current levels, we're at 9%, which means servicing your interest, the prices have doubled. And each individual, especially in the United Kingdom, where people have or 75% of people have mortgages, with mortgage rates doubling, where do you take the additional amount out of your daily budget? Same true for corporates. You run a corporation which is, yeah, fine. It's employing a couple of people, especially small to medium term. And you thought everything is under control. You are not the new, I don't know, Microsoft, so you don't have a market dominating position, and suddenly the bills that come in every month double. What do you start doing? You start thinking about, how on earth do I reduce costs in this cycle, right? And this is also one of the harbingers, I think, of what is about to come. And then we are in this beautiful scenario. He put the yield curve up again. This is obviously the most favorite picture of every bear like myself. The red lines are the recessions we had, and Jeffrey Gundlach summed it up again and said, when the inversion gets negative, which we have seen here, the recession is about to follow. However, the moment we are inverting the 10 versus 2's yield curve, that doesn't mean the recession is imminent. It just means people start talking that the recession will come. It becomes ugly when the interest rate starts uninverting. Yeah, it gets steeper again, and that is what we've seen over the last 4 weeks now, Nic.
Yeah, that's absolutely right. And you know, obviously much bigger things happened in the markets last week, which you know, showed that there's been an absolute shift in how the market perceives, you know, what the Fed is or isn't doing, or even what the Treasury is going to be doing. You know, one, again, it's this yield curve control. It's pushing more issuance in the T-bills. You know, we talked about that.
Let me make a slide jump, because you mentioned that at our Halloween special, we were talking about the figures, the numbers of the week before, yeah? And we decided, oh, the data shows, as you mentioned it just now, everything is awesome. Advanced GDP 4.9, nominal around 8%, awesome, couldn't be better. Unemployment claims just as expected, nothing horror. Flash service PMI better than expected, and core PCE price index 0.3 came down on the spot. So yeah, what's to worry about? And a week later, we had this on the screen.
Yeah.
Unemployment claims was the number 217, 210 was expected, clearly pointing in the other direction.
Non-farm payrolls, you know, disaster. You know, this is the real worry, I think, and I think the market understands that, and I think that's why also the dollar is starting to crack. Because at the end of the day, the likelihood of a recession gets stronger if the market believes that the Fed don't understand, and they still talk about this higher for longer nonsense, because they are just far too slow at understanding what's going on around them. And then on top of that, you've got now the Republicans with a new speaker who wants to get serious about the budget deficit. So if we talk about the growth has come from having a huge budget deficit, and there's somebody who wants to tighten the screws, well, there's a real question mark whether or not you can sustain that level of growth. And I see the interest cost now in front of me on your screen, which is a major issue.
I'm trying to find the nicest chart, and I think this is...
Well, they all look fairly scary. Well, I think this one looks fairly scary to me.
I think this is the biggest sucker.
Or the one with defense. You had one with defense as well, you know, sort of versus defense.
Okay, yes, but only defense. Yeah, let's look at this one. U.S. government interest expenses in % of tax revenue. And you have the Congressional Budget Office. This is the white thing with the baseline, which is very interesting there. Their forecasts are, we are now in 23, and we see interest rates at lower levels, 2 to 3%, and that leaves us with 20% of interest payments getting out of the budget. However, if we look at interest rates where we have them at the moment, let's say 6%, the yellow line we have in here, that would mean that in 2033, shy 10 years from now, almost 50% of the budget will have to go into interest payments. And let's assume for a moment what they're doing. And we had this fantastic show, by the way, when we were talking about the death spiral 2 or 3 weeks ago. What will happen? They have to refinance themselves at ever faster pace. That will lead to rising interest rates, which makes their debt payments even more expensive, so they have to churn out more bonds, which will make interest rates rise further. And then actually the 9% interest rate or something around 8% interest rates, if we have a persistent inflation and high interest rates, would lead to the fact that up to 70-80% of the budget will be eaten up by interest rate. That's simply not sustainable, right? You can
absolutely. Absolutely. I mean, do you honestly think that when somebody says, oh, we need to spend this much money for X, Y, and Z reason, Biden has already made a trip towards the Middle East, comes back and says, look, I've promised 100 billion to our sort of, the people that we're supporting. You don't have 100 billion. You have nothing. Where is this money going to come from? And, when the Republicans and the Democrats sit on opposite side of the table, and they're going through their little ledger and they're saying, well, let's cross this out and let's cross this out. No. We don't want you to cross that out. The only thing they're arguing about is billions, but small, right? The big number is the number that you've got on your screen right now, which swamps absolutely everything. Absolutely, all of these numbers, it's bigger than the defense number. So if you try to say, where should I spend my money, on defense or on interest rates? And you say, oh, that's no problem. We're the Americans. We can continue to issue our debt and people will buy it. Well, that's the thing, really, because, we talked about this before. Who is going to buy it? Because it's not the foreigners. So it has to be domestically financed. And that's when you start to squeeze your economy, because money stops going into growth, into companies, into research and all of this stuff, and it just goes to pay the holder of the debt.
Yeah, I'll come to a most fantastic slide in a second, but let's first go to this one, because Gundlach showed he's a what is it, boomer. We are boomers, Nic, aren't we? So a boomer. And he said when he was young, he played with the dynamite shack from MB Games, which is pretty much, you had I don't know, it looks like a shack, and you had to put dynamite sticks in the top, obviously lit, and eventually it blew up. And you're obviously I think you were winning it if you didn't lose your thumbs. That's what the picture shows here. So if we see that, yeah, and we've analyzed it, that obviously the sovereign crisis here is huge, especially if they get into this death spiral. Then we come to the master of decisions, and that's why I actually wanted to quiz you. I love this slide. It shows Jerome Powell in the middle, and the orange bits are thinking about it, and the blue bits are already tried. What can the Fed do to actually, defuse the situation we have with a shack full of dynamite, and just get a couple of the blue things in? Nationalize banks, tried it, done it. Increase spending, done it. Forgive debt, done it. Cut taxes, done it. Raise taxes, done it. Quantitative easing, done it. Print dollars, just keep borrowing. Elect Donald Trump, even that was tried. Normalize rate, raise rates for no reason. You remember the temper tantrum in 2018 when they said they were on, we were tightening the money supply and we raised rates just for no reason at all. And then the market showed him the middle finger and said, no, you're not going to do it. And they decided, oh, we better don't do that. Otherwise, we see a bloodbath here. Negative rates have been there. Helicopter money have been there. So that leaves us. And that's why I want to quiz you, Nic, as junior bond god. They have three options: print and pay, a wealth tax, or default. What's it going to be?
I actually think the decision is in the hands of the Treasury for what they do, because I don't think, any of these decisions will come from Jerome. But the notion that the Americans default, I think, is not worth thinking about, even though you've got thinking about it on the top left. Wealth tax, you see, that's quite an interesting thing. I don't think wealth tax is the thing they'll go for, but they may well try some kind of corporate tax increase, because company growth, earnings growth is really being driven post-tax. And it's not really being driven, top line. It's really being driven below the line. So in other words, the after-tax earnings are rising. So it wouldn't surprise me if they do a bit of wealth tax. So it's not wealth, but it's corporate tax. and an awful lot of print and pay because they don't have a choice. And what suffers when you print and pay? The dollar, right? So, and this is where we talked about before, you need to have some hard assets, whatever you define as a hard asset, gold, Bitcoin, silver, perhaps some property here and there. You don't have too many choices left, frankly, because you are being absolutely squeezed and you are strangling your economy. And of course, we spoke about the idea, I mentioned it last week, an idea which Luke Groman mentioned years and years ago, which made no sense a few years ago, but it makes an awful lot of sense now, is using the gold and pricing your gold. As I said, I throw a number in here, $20,000 an ounce, to basically put your treasuries as gold backed. And then you don't have a problem. Right?
Well, Roosevelt did that, didn't he? From $25 or $23 to $35. He prohibited everybody to hold gold, collected it all, and suddenly said, okay, an ounce is worth now $35. Thank you very much.
I mean, I think that the governments, and I, question mark even the Chinese whether they would do it, but they might, as I say, this was an idea that it sounded far-fetched a few years ago, but in the current environment, it adds you another one of these little pies as an alternative thinking about it thing, using gold as backing for the debt and repricing the gold. I mean, why should it be 2,000? Let's make it 20.
Well, Lisa's with the question then. China central bank is one of the biggest gold buyers for the last 6 to 8 months. Yeah? If the Americans would do that, what are the Chinese suddenly doing with all their dollars?
Well, you see, what are their dollars are treasuries, right? So, in this respect, they have treasuries. They've got, I don't know, trillion of treasuries or 800 billion of treasuries, and that's their dollars. And they gradually sell 15, 20 billion a month, very steadily. But the point is, the economy in the States is absolutely strangled for the next 40, 50 years and some. So you have to come up with a solution that is a kind of a big bang. Otherwise, you just have a slow death. And I just can't see any other. I mean, even the print and pay thing or the wealth tax, or it kind of doesn't really solve the problem. You need to get rid of the debt.
Default is out of the window. I'm totally agreeing there. Otherwise, the reserve currency and all the benefits that come with it is done. So that's not going to happen. Wealth tax, that would again be the stupid decision. Instead of growing your out of the inflation, you would strangle that. Doesn't make any sense. Print and pay. Yes, of course. What's the only option you have left? And then, how did you call it? Command and control economy, right? When they simply fiddle around with the interest rates because they have to, no other choice, to save their sovereign debt problem they have in there. Wait a second, I'll try to find the right slide to go through there because I found that very interesting. Gundlach was then, I saw him again. As I said, I was sitting to the interview with, or the presser with Jerome Powell, which was a bit boring besides the one point we're not thinking about lowering interest rates. But afterwards, they had Jeffrey Gundlach on again on CNBC for half an hour. And it always culminates, and obviously, what are you going to do? You were bullish on the long end of the bond market for a while now. And that didn't seem to be quite right. However, he said, now is the time, and we've seen it, well, for the last week, actually. He said, everything looks good. Everything looks rich at the moment. And he said this, the sovereign debt problem we have, the solution, we have still Powell on the screen here. They'll have to take interest rates down. Where are they? Where's the Fed working? At the short end of the curve. So he said, short end looks very, very rich. And the line I used earlier, they're not going to reduce by 25 basis points, but they will go in big steps once the recession hits, which he expects to be in the first quarter or second quarter of 2024. Then you actually want to be in the short end. Also, one of his lines was, bill and chill. Have bills and chill. I like that line, we are now, well, I am in treasury bills for a while now, because I thought, yeah, 5%, fine. You sit on the sidelines, wait what's going to happen. I like this notion. And then I thought, obviously, and then we can also go to the equity market. What could I offer to our viewers if a scenario like that comes in? And I went through the ETFs available, and I went into the SHY by BlackRock, 1 to 3 year treasury bonds. And I found that quite interesting. Before the recession hits, and now we see the employment data coming in, not so good. And it might manifest now in the first quarter. What you see here is the monthly chart of the 1 to 3 year treasury bond ETF, the SHY. Every time before the recession hit, you had to go along this thing. And it was a massive move, because then you had the classic steepener where the short end was pumped down to an unbelievable degree, because that's what the Fed can do. They have to flood the market with money. And if we go into the daily charts, we've seen that over the last 2 days, suddenly we have this gap to the upside. Monthly chart, I think, is more convincing. I'm not a day trader. That is the thing where I think chance risk relation, if eventually the recession will play out, could be a very interesting position to put some money in. He was then asked, so are you going to the short end now instead of the long end? He said, no, the whole curve looks fantastic.
It's absolutely, yeah. I think I understand the logic. Makes a lot of sense. As we talked about it over the last weeks, and we did the maths. We showed the maths that actually you hold a 10-year, yields go up by 50 basis points, you probably don't lose anything because you get the coupon and so on, convexity and the way that the prices work, you're probably flat, you don't lose anything. But if yields go down by 50 basis points, you make 6, 7, 8, 9%. And that means you've got an asymmetric payoff at the end of the day. And I think we've reached that kind of level where it makes a lot of sense for anything right now to be long. And, if you like the bond market, that's supportive for the equity market. And already a couple of weeks ago, I said, I see a great opportunity for asset managers right now to allocate money into the market, because I think for the next 6-9 months, you've got a really good opportunity now to make money on both sides of your sort of 60-40 portfolio. The problem comes, and we'll talk about probably another show, the problem comes when, the Treasury still have to solve the problem of all of this debt. And when the only thing that they're effectively issuing is T-bills, suddenly they become like Northern Rock. And for those who don't remember, Northern Rock was in 2007, good old English bank, where there were queues of people to get their money out, and they were heavily financed in the short end of the market. Well, now you've got the world's biggest, strongest country, basically financing itself like Northern Rock. That's pretty. So longer term, I still see a problem for the US to solve. Short term, I think there is an investment opportunity, and that's how I see it as well.
Well, Northern Rock didn't have the advantage of being able to print their own money. That's the difference.
Yeah, but you know what? The Americans won't be able to print their own money either. If people don't feel comfortable that they're really going to get their money back on this stuff, this whole refinancing risk may become a problem, and then you do have a problem in the short term, because yields can suddenly jump over short periods of time when there's no one there to buy the stuff. And if the Fed say, well, we're not buying anything, or if there's a loss of confidence in the system, that's when you get this kind of hyperinflation thing, and that's a story for another show. But I see that as a longer term risk that will not go away, because the debt situation is just horrendous.
That's what you mentioned, the command and control economy would fit in there nicely. You simply say, okay, fine, you don't want to buy our bonds. We make laws, all insurance companies, everybody. You just have to buy government bonds. That's it, story. No, nothing on the other side anymore. Why buy foreign bonds? You can buy US bonds. Be our guest.
Sure, absolutely right. They'll stop people from buying equities overseas. They'll stop people from buying all sorts of stuff. And this is actually a kind of a discussion that I had with Russell Napier. Russell Napier believes that, or my understanding of how he sees the world, he sees that it's most likely going to come to a point where the government will legislate to make sure that there are institutions that support the debt. My view was, I don't think that's going to happen. And, the Fed are going to print and the currency is going to go to rat shit. So, you take your choice. But both solutions are not clever, frankly, because they will crowd out where money is meant to go into an economy. If the only thing you're feeding is the debts that you've incurred over the years, and it's not generating growth, because every dollar of debt has a declining marginal impact on growth. I think the last chart I saw is like $1 of debt is 40 cents worth of growth. You come to a point where what does the repaying the debt actually achieve for you? And that's why I say that the future is bleak unless they really do take a slice out of the debt. And as I say, this gold thing is quite interesting.
I think it's, you said the repayment of debt. Haven't we given that up a long time ago? Nobody actually considers ever that they're going to repay debt.
Correct, but repayment, refinance. And, we always accepted refinance. And maybe comes a point where you say, no, I don't accept refinance. If I have a choice, I will not refinance you. And that's the whole idea about sort of building your debt profile under different maturities. But what we're seeing now is that, 50% of the debt pile of the US is 2 years, is out to 2 years, 1 year and 2 years. That's a phenomenal risk that the government is taking to always find buyers of this debt. And if they don't force them, people might say, hey, you know what? I want 8% from you now. Why not?
Yeah, no, I'm absolutely with you. It's so as I said, just last word on the shy, there are also options available on this product. Just to give you an idea what you can do with it. And obviously this is, if you just want to play the underlying, fine, you can leverage that up. If you're so inclined to do, I think there's a good chance risk reward in here. I think Gundlach has a good point there, just as Nic has a good point there. What cannot happen must not happen, and therefore will not happen, because the consequences are, well, ridiculous. So we don't have to think down these lines. And then obviously he was also asked, I'm trying to find the slide, equity markets, what's his opinion on that? And we discussed that last week successfully with a week on and a little bit scary charts. That was a chart we had on last week, Nic. You did a fantastic analysis with Elliott waves there, and if I remember correctly, this was the point where you said if that holds, you have to go long.
Yeah, and I'll tell you what, I don't sweat very often looking at markets, but on that Friday night I did, and I was so confident even when it was trading down. But the last hour or so of trading, I mean, they really wanted to break this level, and it was an important level to hold, 4,100. It was the old high from the previous year, not the previous high, and it still opens the door therefore to a new high. We're still not out of the woods, but it does open the door to a new high. So we survive. We live to fight another day.
Now, well, one of the things is obviously we also said that was the podcast I listened to Friday before, Peter Schiff, where I told everybody on air about it, where he said, no, he's got his boys working on the weekend, so you could still buy lots of gold, because the crash could happen on Monday or Tuesday, because that was still October. And it was a bit mean and said, well, there you have an indicator. And Peter Schiff says the crash could be Monday or Tuesday. And what did really happen? We went into the chart with the seasonalities. That was interesting. Yeah, we see, especially in this red line, which is 2 years Democratic president in, you've always seen a massive move to the upside end of October, last 2 days. We've seen that. Then we see a boring November and the year-end rally. Also statistically, November-December period is the strongest month over the last, since 1950, past 20 years, past 10 years, and past 5 years. You can see it here. If the market follows the playbook in seasonalities, that should be the point to say what we also said. Yeah, maybe the party is in December, after everybody has been, well, the shorties have been handed, how do you call it? Have been handed the bag, because that's what we are seeing here. That what happened last week.
Phenomenal.
For me, this move seems to be a little bit too brutal, too fast, to, oh my God, that is the only thing where I thought, no, that doesn't look sound. Yeah, I've seen stuff like that before. That's usually where at levels like this, my trader heart would say, well, let's sell something. Yeah, just have a tight stop. But in a move like that, I expect a correction or a level down to, you mentioned it. Yeah, I think this level should be retested.
Well, if you look at the Treasury, the chart on the Treasury, so yields actually fell very sharply in the US Treasuries as well. And remember, these two things are now correlated. So they're both going together. Yeah. And whilst you've still got yields in decline in the US in the 10-year, there's no reason for a crash in the S&P, and you've seen almost a full retracement of that last move. And I think, you've seen a 30 basis point retracement, 40 basis points even, in 10-year Treasury. So you've almost recovered that last big move in the 10-year. So the two things are going together right now. So, before I decide on one, I'll look at the other. If we're right about sort of being long on treasuries, as it doesn't matter what part of the curve you are, then that should be supportive of the S&P as well. And let's not forget, we're just at the tail end of the earnings season, and earnings are not that bad. I mean, the forecast for next year is slightly lower as of last Friday. I haven't looked at this Friday's numbers, but last Friday, we were still very close to 12% growth on earnings for next year. That's okay. The market's kind of okay priced.
Oh, by the way, the tail hedge we put up a couple of weeks ago at 20 cents, and which was then 5.5x last week. We bought it at 20. It was trading at 130. Guess where it's trading now, Nick?
Probably very small.
It's trading at 5 cents. What does that tell me? That tells me, even though there's still juice, it expires on the 30th of just after Thanksgiving, which was the original hedge. And there is still some time in. Realized volatility is enormous. If you just look at the chart, the option market pricing this thing at only 5 cents. Now you have a 20-1 chance to win again. Seems to think, it's not gonna burn down the house anymore. We've seen the down move, we've tested the low. Elliott wave seems to confirm that. And even though if I think the move to the upside was too fast, too brutal, the equity market boys think 5 cents, fine. If anybody can sell it for that, fine, I take that. So just a point for consideration. Would I now cash in on these 5 cents? No, never in hell. I'll just leave this thing lying. Everything could happen, especially in this geopolitical time we're in. If we see the retest soon, prices will explode again. We didn't spend much at the beginning, just to give you an idea how different it is if you're a trader, how you make money out of these markets and cash in, and if you're an investor, how you actually say, fine, that's my insurance premium, I paid that. That will vary during the time what the contract is worth, but I still have it here. I can sleep well. It could come back now and this thing starts living again. Just want to be fair. So that's everything from my side. Mr. Gundlach, let me close it there, said when he was asked about equity markets, he thinks, yes, there is room, for the simple reason interest rates are coming down, and that is like fuel on the fire, especially in the high beta stocks. I've seen another chart. I don't have it in here, but it simply showed what's the performance of stocks that don't make money, have a bad outlook, but are high tech, which are suffering extremely from high interest rates. And brings me again to the point Darius Dale said that a couple of weeks ago, just before the party ends. It's really, really cool. You have a lot of fun going on. That with the seasonalities and maybe the low test we have seen here. Maybe good old perma bear Thorsten has to wait another couple of months before this scenario gets in. The shy I showed on the screen is actually something interesting. A good chance risk reward ratio we have in here, which I definitely going to have a closer look into, especially if I can do something on the option side with it. Otherwise, I thought this was quite brilliant. Mr. Gundlach's analysis about the scenario. We spoke about that. Well, since we do the podcast, where the hit is going to come from which side. And that I thought had to share with everybody. So thanks again for the Bond God and the Bond Junior God who guided me through this experience. Nic, one of these days, you'll get promoted to senior bond fund. And do you have any famous last words before we finish here?
I looked very briefly at Apple on Friday, and I was actually pleased to see the price of Apple fall and the small caps rise by 3% that day, because I still maintain that the best thing for Apple is to go and buy some tech stuff within the small caps if you can. So it's good to see that trade move.
He said it last week. He said it today again. Thank you very much. I'm not adding anything. Thank you for watching. Please subscribe, share our little conversations. We're looking forward to next week. Thank you very much, Nic.
You're welcome. Thank you, everyone.
Bye-bye.
Bye-bye.